Okay, well, I figured this out. Why don't you give your lesson on order blocks and fair value gaps? Do you want to do that?
Yeah, it's more a sort of Q&A, and I obviously you've put in the whole order block fair value gap setting on MT4 so people can see where the bullish order blocks are and the bearish order blocks are and fair value gaps. And we've had some pretty cool talks on the actual Discord. We have asked questions and everything like that about, why order blocks, what are fair value gaps, why fair value gaps left behind. And I think it was Tola that was pretty much spot on and pretty active in that. There's a few guys that are active. So who wants to speak and who wants to tell me what their understanding of order blocks are and fair value gaps? Tola, maybe you'd like to share with us. What do you think? You want to put your hand up and have a chat? Excellent. Are you, Tola? You well? You're on mute, just so you know.
So, Tola, at the bottom of Discord, there's a mute button. Just click it to unmute yourself.
Okay.
Cool.
Can you guys hear me?
Yeah.
We can, Tola.
Okay, thanks. Good. How's it, Alan?
Good.
Yeah, I think my understanding is that the order blocks are the areas where the institutions have their orders going, and those are the levels where you can expect the market to take support and move in the other direction. And the fair value gap is created once those orders is placed and the market actually extends to beyond where it's supposed to be.
Yes, I like that. That's pretty much spot on. So let me expand on that and let me build the picture for you. So what Alan's teaching us from the get-go is to trade like an institution, is to be able to mirror the institutional tactics. So for those of you who followed our conversation on macroeconomics, it's quite a critical to understand why, because institutions are there to make money. Their mandates are very much the same as the EA in that they are responsible to invest. They are responsible to make money. Their mandate is very much a long-term mandate, which is why they DCA, which is why they don't work with stop losses, which is why COT gives us an inside picture of their world. Their mandates are years. They can sit in the trade for years, And so Alan's basically started off his journey through his mentor, understanding how to read candles, but also looking at moving averages, because at each moving average is where the institutions play their game. And what we've added to that is your moving averages, and then you've also got your order blocks. And like Tola said, that's where the banks have their orders. Now, we know that Forex is a one-to-one market. So where there's a winner, there's a loser. Okay? And we know that at the end of the day, in order for somebody to make money, all right, they've got to take somebody out. Now, a lot of the times, it's the retail market that they want to take out. But institutions generate liquidity with institutions because they've got the money at the end of the day. But they use the order blocks, okay, as a starting point to be able to try and create that liquidity. And those order blocks, once the orders are placed, and they start buying their orders at a specific point, and we're talking about a bullish order block here, where they start buying gold at a specific point, the investment and the volume of cash is so huge that it leaves a gap in the price. Now, if I take a step back, what I've always said to Alan and to you guys from the beginning is that any market likes to be efficient in its pricing. In other words, it doesn't like to leave gaps open. It wants to be efficient. It wants to close all the gaps. So when there are inefficiencies, which are fair value gaps, because of the investment volume is so large that it leaves that inefficiency behind. It leaves that fair value gap behind. In time, price will come back and close those fair value gaps behind. Now, if we knew, okay, when that time would be, we'd all be billionaires. But that order block and that fair value gap is a key. Like COT is a key. Like a moving average is a key. And we know that when price starts breaking down and starts breaking structure lower, and the second candle opens below an ATMA, that there's a good possibility and a good probability, and we talk probabilities because we have to talk probabilities. We have to talk percentages because we just don't know. So there's a good probability that when a second candle closes behind, underneath the ATMA, that there's a good chance that if we break a MA as a confirmation, that we're going to go and close that fair value gap, that we might revisit that order block and so on and so forth, because it wants to be efficient. It wants to close those gaps. Now, when it moves lower and it closes that gap and it hits that order block, there's two scenarios. Are there enough institutional orders left over, one, okay, to stop the price from moving lower and act as a support? And number two is, are there institutions going to look at that level where that order block is for fresh investment once again to push the price back up to a new high? If there aren't any orders and if the institutions don't want to reinvest, that price will break that order block, close the fair value gap, break the order block and move lower. All right, and it will then close the next fair value gap, revisit the next order block, and then the same two questions are asked. Are there enough orders there for it to move back up? And are the institutions going to reinvest at that particular order block, which is in fact a support level? And I'm talking about bullish order blocks, because bearish order blocks are exactly the same principle, but obviously the institutions are looking to sell. Okay, so now let's take that in conjunction with the MAs and COT. Okay, now we've learned that COT is a longer term picture in line with the mandates of the institutions. Now, when you're sitting with 370,000 contracts long, okay, and you're sitting with freaking, what is it, like
I'll pull it up.
a tenth of that as short, okay, you know price is going to go up. Okay, so now we know that currently we're in bullish phase in gold. We know that there's a war going on. We know that the Feds are cutting interest rates and so on and so forth. And we know that price is going to go to a new all-time high, but we don't know when it's going to go. So right now we look, okay, to the MAs, key number one. We look to the fair value gaps and the order blocks as key number two. And that's how we trade. And that's why it's so critical. Like Justin, you asked the question earlier on, okay, where we feel the different levels are. Well, for me, I've just answered that question. Key one is your, and key two is your order block. Now, I can show you over and over and over again, if you go back in price, where prices revisit order block. Yeah, there's a lot of echo now suddenly. I agree. I'm trying to ignore it, but it's there wasn't an echo. Hell, I don't know Yeah, go back to 4 to see if that echo disappears.
Talk. Key?
Yeah. You still an echo?
No.
Because I still see your Discord. I don't see your empty. I did just now.
I was sharing another screen. Wanted to share the COT data. Okay, there we go. Cool.
Okay. There we go. Now there's still me. Okay, let's just push through. So, I show you time and time again where price has led the value gap because of the investment and volume on this to push price direction. Okay, the market is inefficient. Okay, and has come back,
Yes, that's terrible.
closed
We can't hear you
and touched the order.
Guy, we can't
Okay.
hear you. It's like
Is it bad?
it's garbled.
I don't know what to. Because it was try MT4 exactly like this one.
You want me to go back to MT4?
Back to MT4.
I don't think
Okay.
it's got anything to do with that.
Yeah. Okay.
Just log back off and log back on again.
Yeah.
Okay, so just to give you my 2 cents, it's just an indication, it's an indicator that there is a possibility of there being a support and resistance line. So if you go to, like, I've built this indicator for you guys, and if you do purchase it, it comes the subscription on the Learn to Read a Forex chart. This is not a sales punt. I'm just telling you that you can add the order blocks to your chart, so you can now see what's happening. You can also it can send you a notification to your phone when the price is nearing that order block, so that you can know whether you want to place a manual trade or not. So, I mean, if the price bounces off this order block over here and you get a nice big green candle, maybe it's time to place a buy. Also, just to expand on what Guy was saying with regards to the COT data, it's the commitment of traders. Let me close this. It's the commitment of traders, which is basically what the institutions are doing. And as you can see here, the institutions have got 370,000 standard lots. Each lot is worth $100,000. Okay, so it's 370,000 standard lots that are long, and they've only got 70,000 standard lots short. And last week they added that they removed some of their long positions. They took profit. So I wouldn't say that they are reversing and they're now going to be going short. I believe that they are just closing out some of their longs. They're taking profits to lower the price so as to place new dollar cost averaging trades on the way down as the price is coming down. And then when it gets to possibly another order block, they'll start adding their longs, some more big longs, and they'll go long again. So if you've got questions, unmute yourself and let's talk about this so that you guys can understand it. Because once you start understanding this, okay, you take your trading to the next level and you can then start manipulating the Rule 2 robots to place trades more efficiently for you and strategically, so that you can gamify this and have some nice trades at the bottom on an order block, so that when it does reverse, those trades go blue and you've got a nice big profit to cash out on when we get to an all-time high, or when the price reverses from its long into a little reversal short again. So please put your hands up. I know it's complicated and it's going to take you a little bit of time to absorb this and digest this and understand this. So it took me a little bit of time to understand it, and I'm sure it would take you also a little bit of time to understand this. Okay, so ask your question, Justin.
But I think it was really around the reliability of order blocks, because often, they act as magnets to attract price, but they're also used for market manipulation to institutions may actually cancel the order blocks as well before those are fulfilled.
They can't cancel an
so I'm
order
just
block. An order block is there, and then if the price goes through the order block, okay, and it melts through the order block, then the order block is cancelled. If the price bounces on the order block and goes north, then that order block is an order block.
Can you hear me now?
Maybe my misunderstanding is there. So it's not acting as a trade and saying there's an order for X amount sitting at this level.
We just
and the
know.
institution
Okay, so
has
let
the
me draw it
for
out for you. Okay, let me draw it out for you so that you can understand what exactly Guy is talking about. Okay, I'll just try and find an order block here so that you can see exactly.
And these are good questions.
Very good. So here's a nice order block.
The unfortunate part B of the question, to add it on, is to go to again an ask or feature add-in on the next version to start saying how do we start allocating a percentage of our equity or wallet to say I want to speculate with X amount of dollars and have that provisioned in your wallet, and say allocate this to order block bars or DCA bars. And get the EA to start picking up on some of that at specific order blocks, at specific allocated.
We can't tell you that,
amount.
but that's what the the ATMA indicator is there for. It's there to show you where the order blocks are, so that you can then make a decision based on your risk appetite if you want to then place a trade there and manual trade, or force the robot to place a trade. With whatever lot size you prefer, and nobody can tell you that this is the right time to place a trade. Number one, we're not financial advisors. Yeah. I'm not. Guy can, but I'm not, and I can't give that advice. So here is like an order block, correct, Guy?
Just make that bigger.
Okay, I'll do it again.
Yeah, so you'll see that there's an order block that left that fair value gap behind.
Correct.
Okay, so that particular level there below the red box, okay, is an investment level, okay, where the institution came in.
It's a demand zone.
Demand zone, you can call it that. All right, that has pushed price up so heavily that it has made price inefficient, left a fair value gap behind. That's all it is. It's the same thing. Efficiency in price and fair value gap is one thing.
So here's your order block over here. This is where the institutions have their demand zone. This is the fair value gap candle over here, which is that big red candle, the big green candle, which basically pushes the price north. And when the price comes back to this area and pierces through here, this order block disappears. It's no longer an order block. It now goes to the next level, the next order block, the next support level below it.
As soon as price tapped into that order block, okay, two things happen. Either they suck up all the orders that are sitting there and push it lower, or there's enough orders there or fresh investment there to bounce off that and create a new order block and a new fair value gap.
There could
original
also
order
be,
block falls away.
There could also be, because the institutions, now what I've learned is that there are only 3 to 5 hedge funds that can actually move the market properly and that know what they're doing. The rest of the hedge funds follow these big guys. Now, the 3 to 5 hedge funds, we don't know who they are. But what I can say is that because those 3 to 5 players know that they can move the market, they may also, on that order block, place sell orders. So instead of it being a demand zone, it can become a supply zone.
Because they pushed it through.
Correct. And the only way that it pushed it through is because of those 3 to 5 hedge funds that understood where their orders were and where everybody else was going to put their orders. They manipulate the market, they trick the market, they bring the price down, they basically liquidate those orders, they close out their longs, their shorts are activated, and the price continues to go south to the next demand zone.
And think about it logically about what we've been learning together is let's look at fundamentals. Maybe there were mega orders there, but suddenly there's a war or suddenly something fundamental changes out of the US, like rate cuts. They're going to pull their orders there. They're not going to leave it there for a new investment. Who knows? If we knew that, we'd be billionaires. The fact is that they leave a trace behind, of what they did to push price in the direction that they want to move it in. The question we have to ask ourselves, understanding that price is efficient, when it revisits that level and closes that fair value gap, are the orders still there, yes or no?
You broke up. Repeat your question.
When we know, my freaking earphones are giving me cuck. Hang on.
I'm trying to move the history. Yeah, I can hear you.
What I was saying was, because we know that the market moves efficiently, when they revisit a level, they've closed the fair value gap and they revisit that order block. Okay? We have to ask ourselves the two questions. Are there enough orders there, or have they removed their order? If there are enough orders there, there's going to be a fresh bout of liquidity investment. That old order block is going to disappear, and they're going to create a new order block, to push the price in the direction that they want to move it again. It's going to leave behind a new order block, a new fair value gap. And the fair value gap is an indication of the investment based on that order block.
So, Guy, just to qualify that, in terms of time frame, do you typically, does it depend on what time frames you're trading in, or do you typically look at a 4-hour or a daily order block to be the most prevalent in terms of guidance? What time frame do you judge an order block by?
Excellent question. Now, I'm not going to complicate your life. We trade on a 4, so we focus on 4. Okay.
You got to fix your sound, brother.
I don't know what to do, bro. I honestly don't know what to do.
Did you reboot?
My whole machine?
Yeah.
No, I'll be back.
Okay, just reboot and close down all your apps and then only open Discord. Okay, so Justin, just repeat your question. I was busy fixing my screen.
Sorry, Alan, I was just asking Guy, in terms of evaluating an order block, its robustness, in order to take a trade decision, do you typically look at a 4-hour time frame or a daily, or does it basically depend on the time frames that you're trading in and making trade decisions? And so is it based on your trading windows, or how do the institutions typically manage that or look at it?
So some people have got a high risk appetite and they'll place their trade. So there's different ways that you can do this. Okay, so here let's go back to the ATMA. So here is an order block. Okay, so what you can do is you can place a dollar cost average buy trade here. Nobody can tell you for 100% certainty that the price is going to go north or the price is going to go south. There are millions of strategies out there. I've just found that my strategy holds the best water. I've gone through thousands of strategies and nothing has beaten my strategy. And again, I'm open to listening to other people's strategies, but if you are going to talk to me, please make sure that you've got statistics to back it up to show me that your strategy is beating my strategy. I'm always open to learning. Okay? So the dollar cost averaging principle is something that has been developed by all the hedge funds. And what they're saying is they're saying it doesn't matter where the price is, just place your trade. If the price goes against you, it's okay. So I'm going to give you an example of how the robot trades. I'm going to share my screen. So I know it's a bit long-winded what I'm doing, but it's important that you get this and you can understand this. Add window. Okay, add window. Okay, cool. So let's say the price is 2,700. Okay, and this is trade 1. Then, okay, and this is a buy trade. Okay, so these are all buy trades. Okay, and you're hoping that the price goes north. The price doesn't go north, and let's say it goes down to 26.50, and there's an order block at 26.50. We're hoping that it's going to go north. Okay, but it's a good opportunity to place a buy trade because COT data is long. Do you agree with that concept?
Yep, following.
Okay, guys, put your hands up. I will then add you. I'll then add you. Okay, if you want to ask questions. Okay, the price, that order block is broken, and the price goes to 2,600, and we place another dollar cost average trade. Okay, so that's trade number 3. The price goes through that order block, and we get to 25.50, and maybe 25.50 is the correct order block. Now, this is where lot size and wallet management is key and an integral part of your trading. This is where most people blow their accounts. They'll blow their accounts at trade 3 because they are over rambunctious and they over leverage their accounts. They don't understand that they're not in control and that it can go against you. This is why you need to use small lot sizes and not be greedy and be good and cool with the fact that you're going to make X percentage on your account, whether it's 1, 2, 3%, okay, on that trade. These 10% and 20% profits that people are making, they are not showing you the full picture. They are not showing you the amount of accounts that they blow. They are only showing you, it's clickbait. They are only showing you when they make the profit. And their accounts are tiny, $100, $200 max. Okay, and then they'll maybe make $1,000 or $2,000 on that trade. But the risk is so large, okay, and it's a stupid way to trade. So you need to use small lot sizes here, okay? And then the price goes up. So this trade goes into profit. So let's say these 3 trades go into profit. These 3 trades that are in profit supersede the loss. In other words, the profit here is bigger. So let's say the profit here is $50, $40, $30. I'll do it differently. $20, $10, $5, minus $15. So net, in the bottom here, you'll see here, it's 20. So your net profit on your 4 trades, you're in profit for $20. That is what dollar cost averaging is. So you can theoretically close out all your trades, bank a $20 profit, and you're good. So to get back to the question of when do you place your trade, let's circle back now. So my strategy is, you know my strategy, I work on the second candle above the ATMA. That is my confirmation. Although I trust the order blocks, I've seen it melt through. I prefer not to manual trade at the moment. I'm just too busy. But when I was manual trading, I would place a small DCA trade on the order block. Okay? And one at the bottom as well. So let me just switch off here the fair value gaps, okay, so that you can see here where the order block is exactly. So the fair value gap is the big green candle, okay, that engulfs all the candles next to it, including the wicks. So you can see that the institutions have placed, that order has been placed, it triggers, and there's a massive green candle there. That's what a fair value gap is. The order block is to show you where the previous order block was in history. So if we go back, let me go back. We'll show you where this order block was. So this is where the order block was placed, and here is the fair value gap candle, this big green candle over here. Let me switch it off so that you can see it. This is the fair value gap candle over here. Okay, so I'll put the fair value gap on and the order block so you can see exactly what's happening. Okay, so now you can understand what's going on. It may not be an order block. There is a good percentage chance that it is an order block. But I like to have the confirmation of the second candle above the ATMA. Like over here, I can't trade. So put your hands up if you know why I can't trade. On this lower 25, 14, 25 up to this area here, why can't I trade? Put your hands up. See, this is why you need my course. So you guys can see an order block, but you may be placing your trade in the incorrect position. You get caught, you place a big trade, and then you run into trouble. Why do I not place my trade at this level? At this level?
I think it's at the 200 EMA.
Exactly. So the 200 moving average for me is a no trade zone. There's nothing more to communicate about. Those are my money rules. Those are my trading rules. My money rules are my lot sizes. My trading rules are my, what does my golf coach say? He says, these are the rules. He says the non-negotiables is what he calls it. It's a non-negotiable.
Oh, that's why.
Because the institutions can usually reverse it on those levels. It's a very volatile place on the chart. The institutions control that area, and I'd rather not be caught trading against the institutions. I'd rather wait for a breakout above this area here, or above get a fair value gap, second candle opens above the ATMA, then I'll place my trade. Then I'm comfortable. Or if there is, I'll just, let me go back here and show you. Okay, so where would I place my trade? Let me put a line down. That is where I would place my trade. Above the high of this channel. So there is a channel here. There's the channel. It's a little bit lower. There's the channel. So when the price goes above this wick, I would place my trade. But it's got to be the second candle above the ATMA. So here, this is candle 1. This is candle 2, but it's a doji, so I ignore it. This is candle 3. I would be in the trade over here. I'm quite far above the ATMA. I think I'm 80 pips above. Let me just check. Yeah, I'm miles away. I'm 250 pips away from the 200 moving average. So I'd be placing my trade there.
And then look what happened.
And look what happened. Exactly according to my trading rules. Okay, so I find that you can place your trade here at the top, you can place your trade here at the bottom, but you need to be careful with your lot sizes. Are you guys excited about this concept? It's such a clever strategy. Okay, Guy's got his fundamentals and his technicals that he's added to the that he trades by. I've got mine. We've brought it together, and we're both using each other's trading system to enhance our trading technique.
There's actually no.
Say that again.
By the way, everybody in the chat echoes except you.
Everyone echoes except me.
Correct.
Hello, 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 hello. Is that better?
Now we all.
Okay, so Morno wants to say something.
I'm going to speak and say one thing. Your MA are your levels. Order blocks and FVGs are my levels. The principles are exactly the same.
Yeah.
Your 200 is a no trade because you don't know whether banks are going to reinvest at that support or they're going to push the trend and push it lower, below the 200. How is that different to having an order? Okay,
How's that different to?
having an order block.
No, it's exactly the same.
Exactly the same. Now, the confluence, I mean, many people ask confluences in the group, is it's not an accident when you've got an order block at the same level as an MA.
True.
And we're seeing that right. You know? Yeah. Ask questions.
So Justin unfortunately got kicked off. Now, do any of you have questions relating to the increasing and decreasing of lot sizes? I know Percy did. So Percy, I'm going to invite you to speak. So there is no stupid questions here, guys. Some people are at a different level to other people. Some people are more advanced than other people. And this is not a place to laugh, and it's not a place to make fun of. It's a place to, maybe Percy will ask clever questions that you as an experienced trader will say, geez, I never thought of that. So Percy, over to you, sir.
The question I had with regards to lot sizes there is, I wanted to find out what is the difference when you place manual lot and when you're using the automatic.
Okay, so the manual, the automatic, okay, chooses the lot size based on your equity, okay, not your balance, on this number over here, and it will then decide your lot size for you, okay?
Okay.
When you choose
Yeah, I
manual,
understand.
you can then choose whatever lot size you want.
Okay, so when it's on the MM, it's for automatic.
Yeah. See.
Okay, cool.
Okay. So, do you guys have any other questions relating to the lot sizes?
Alan, I didn't have one lot size. Just another quick one back to fair value gap and order block if
Sure.
there's time.
Yep.
Sorry, just by way of example, if you went onto the Ethereum USD 4-hour trading pair on the 8 EMA as an example,
Okay. Let me call it up.
currently
Just hold on.
all
What is it? USD.
ETH USD. So all fair value gaps and order blocks are all north of the current price.
So there's an order block activated on H4, which is so the nice thing about this is that you can click on this and it'll automatically change your chart to ETH USD. Now there that one. So there's your order block right over there at 856.
You're on daily. Just move to 4 hour, then you might be on the same view that I'm trying to. Yeah. So that picture there effectively is telling you prices only to move north because is that what you're reading?
These are not demand zones. These are supply zones.
So the last 4 hour tagged the supply zone, and we're now just sitting in the trading range and waiting for the market to make a move and make a decision.
So basically, a supply zone means that when the price goes into this area, there is a high probability of the institution selling it further south.
Yeah.
Unless
so
the price goes, unless
4 hour candle.
Yeah.
No, I'm just reading the candle there. As I said, it looks like it's already retracing. So it looks like it's tagged that supply zone and potentially looking to head further south.
Well, it hasn't gone through it.
No, it's just literally touched it.
Yeah, it just touched it.
Hmm.
So it was probably both the ask and the bid didn't go through it to activate it. So it's still a supply zone. So even if it goes through into here, the supply zone is still going to be there. It's only when the price goes through the supply zone, above it, does the supply zone deactivate.
Okay,
So let me
that's
just
super helpful, thank you.
deactivate. There's your supply zone. That was your fair value gap.
For me, I look at that slightly differently. All it has to do is touch that OB and that OB is negated.
Yeah, it was the fair value gap, but it wasn't the supply
Oh,
zone.
the fair value. Yeah.
Yeah.
Yeah, sorry.
So as it touches the fair value gap, what happens is that the fair value gap starts to shrink with the size of the candle until it reaches here, and then the fair value gap will disappear. When the price touches the order block, when it just touches or goes through the order block disappears. It's not an order block anymore.
What does that mean? That means that they've closed the fair value.
Correct.
They make the price
Has
efficient.
moved efficiently.
And then if it goes into that red bearish order block, which created the move down, are there institutional orders there to continue the sell? And are there reinvestments from institutions to push that price further down? If there are, the price action will change by creating a new OB. Okay, and why is it? What identifies it as a new OB is because it's left the fair value gap.
Can't hear you, buddy.
Yeah. The interesting thing for me on
Yeah,
this
we can't hear you,
specific
pal.
chart, it's just showing everything's heading north. So it's just quite unusual.
Well, it's not.
there's
It's
nothing
not
sitting
showing
low-
it's
low
north.
down.
There's very small candles here, which shows to me that there is going to be
It's
a
very
retracement.
efficient.
You're also trading on the 200 moving average. There's no ways I'm placing trades here. Okay. Here you've got a big candle. I may have entered over here, but then there was a doji that formed over there. I would have closed my trade. So I wouldn't be in this. There again. Here there was the price sparked up here, but the candle didn't close. I'd rather wait for the candle to close before I enter. I'm not just going to enter because the price wicked above the channel. I want to know that this candle is going to close a big green candle, then enter. So again, I wouldn't have entered here. But I'm not entering here because we're on the 200 moving average. I don't force my trades. I don't need to trade. Okay, I'd rather the trades come to me, not me go to the trades. The trading conditions must be the trading conditions must be perfect. Okay, I need to be playing percentage golf here, where it's all lined up for me. I've ticked my boxes. Okay, I can trade 200 moving average. Buy. Next, I'm waiting.
So what Alan's is saying to you is waiting for the institutions to show their hand.
Correct. Let them make their move.
And how do they show their price action?
Order blocks.
Create the next one.
Correct. So right now there's
Cool,
no
thank
order
you.
blocks. There's only supply zones. There's distribution zones.
No, exactly. It's just been an interesting one I've been following. So that's what I wanted to ask. Thank
Okay,
you.
cool. 100%. Okay. So is there anything anybody else wants to ask about the new Rule 2 EA?
I wanted to check if I'm echoing.
Okay, so listen, I know my videos and my stuff is slightly outdated. I understand. I'm really hectic. I will get to updating the videos at some time in the near future. But you guys need to just be patient. I'm like trying to fix an aeroplane going 2,000 k's an hour in the air.
Hi, can you hear me?
Yeah.
Yes, Mono.
Hi, sorry, just a concern on the new settings, especially on the hedge settings. It's just a concern for the community. It's set at 20%, and I know it's everyone does its own thing. It's just that it's on the preset, it's 20. And it's chart specific. So if we have 4 charge, and at 20 each, we look at a drawdown of about 80% for all charged to hedge. And then we've got an equity protector sitting at 60%. So can we maybe just look at that? I've reduced mine. I've made my hedge a lot lower to avoid that risk.
Yeah, so I hear you loud and clear. I think it's a relevant point. And you guys need to make your own decisions on when you want your hedge to kick in.
Yeah, Alan, sorry, my concern is that the equity protector might kick in before your hedge. That's my big concern there.
No, it won't, because it's chart specific. It's not global.
The equity protector as well.
No, the equity protector is global. The chart, the hedge is chart specific.
Yeah, so you got chart specific at 20%. So my concern is, if you add all four charts together, 20, 20, 20, 20, your global...
Oh, I understand what you're saying. Okay.
Get close to 80%.
I haven't seen more than 8% on mine. I don't know what you guys are experiencing, what kind of drawdown you guys are experiencing on your MT4s.
No, not at the moment. I'm just concerned if the price go against us.
Yeah.
I mean, at the moment it's fine. It's just if something goes wrong.
Yeah, I agree with you. So what did you set your hedge to? Your hedge on your charts?
5% each to give me a global of about 20.
Are you going to get hedged so quickly?
Yeah,
then,
I agree.
One little sneeze and you're going to get hedged.
Yeah.
I hear what you're saying.
Yeah, my lot sizes are small at the moment, so I'm still fine. But yeah, if I go bigger, then I agree with you.
Mm. Yeah, it's a tough one. I mean, nobody knows really. I think you just got to gauge it and feel it out and see what trading system suits you, what risk suits you. But I do agree with you that you are correct that if all four charts do get to a 20%, you're in an 80% drawdown. It's like it's just an indicator. Like I can't really set that hedge up for you guys and say this is what you must use. So yeah, I need to think about it. But thank you for voicing that to everybody. Anybody got anything else to add or any comments? How are you guys doing with the robot? Are you all making money?
Alan, I just wanted to ask a question. I know you probably deal with it in the 8 EMA group or whatever. But last week on Friday, FPS had something on gold and they had a fair value gap at like around 2,200. From what he's saying, does that mean the market will retrace in the next year or two down back to that gap, or does it not always
What
fill
he's
it?
saying is that the market likes to move efficiently. So where there is a fair value gap, okay, and big green candles or big red candles, okay, where an order block or fair value gap has been created, what he's saying is that there's a high probability that the market will return to that level to close that gap, okay, and then like work efficiently. It needs to like work. All those gaps need to be closed, like with a gap up or a gap down. We know that the price is going to come up and close that gap or come down and close that gap. It's just an observation. It doesn't mean that it's definitely going to come down to that level and close it. I'm sure that there are fair value gaps at 1,600 and fair value gaps at 1,200 that have not been closed. Come closer to your microphone. Come closer to your microphone.
It's basically exactly what Alan said. It's an observation where, because the market likes to move efficiently, but, in a market, you can't isolate it by saying, it will move efficiently. We know it will, but when? We got to look at more than that. We got to look at the bigger picture. We got to look at fundamentals. We got to look at the fact that COT's long. We got to look at the fact that they're cutting interest rates. We got to look at the fact that there's a war, and stuff like that. And the trend is bullish across all the major time frames, and so on and so forth. And then one day, this thing reverses and they start hiking rates again. And this happens, that happens. And the price starts reversing. It starts tanking. It starts closing down these fair value gaps. How far down is it going to go? Freaking, if I knew that, I wouldn't be talking to you, X. So like Alan says, it's an observation. It's good to know. It's good to highlight, There's fair value gaps at freaking $600 made freaking 10 years ago.
Yeah.
You with me? But it's a good observation if you look on a 4-hour chart, for example. There are very specific order blocks in the near term, not so far away, with fair value gaps, and there's MAs hanging around there as well. That's what we should be looking at, because that's more relevant to current price action. So you got to put it, Carrie, if I can say, into context, if that makes sense.
Yeah, no, the reason I'm asking is I've got a $3,000 sell lot stuck down, but I don't really want to get rid of it because I don't have to right now. But I see a lot of people saying rather get rid of it and start a clean slate, but I sort of use it to cover my drawdown as the buyers
Okay,
come
let me
down.
do an exercise for you. Okay, so calculator sites. Okay, so let's do. You had $1,000. Okay, and now you've only, or let's say you had $2,000. Now you've only got $1,000. And out of your $1,000, you're making 20% per month. Can I call it 20%? Do you want me to make it lower?
Yeah, that's fine.
Okay, cool. We do it over a year. Okay? And we calculate it. So you've made $7,916, but you haven't really. Because every month you're going to use a portion of that and you're going to close out your sell trade. So if you're going to use 50% of that, so you means that you're going to make 10% a month. Do you agree with that part? So you're only theoretically going to make 10% per month because 10% of it you're going to use to close out your positions, right? So if we do 10% per month, then you're not going to make 7,900% over the year. You're only going to make $2,100. So the numbers are saying to you, close out the short. Take the smack. That's how I came up with it. It wasn't to something or to say, oh, it's just like, stop it, reboot your accounts. It's like, I can't take it anymore. You are asking so many questions about how do we do the stripping, blah, blah, blah. Mathematically, it makes sense to do it this way. Do you understand where I get the math from?
Yeah,
Okay,
no,
so
the reason I
let's
was asking was from that order block.
Yeah, no, I understand that. I got sidetracked. But there's other guys on here that have got cells. So let's say that I've forgotten what I was going to say. So what are you saying about the order block? Oh, right. So let's say the price goes up. Let's say the price goes up now, okay, continues to go north to 2,800. Now you're not dealing with a $3,000 sell trade anymore. Now you're dealing with a $5,000 trade. So your problem has exponentially grown. Instead of cutting it out now, it's like festering, getting gangrene, getting mold, and now you have to drag this heavy load along with you, and the price may never go back to 2,500. It's like, let me ask you this question. Do you think the price is ever going to go back to 1,600? Like, imagine having a sell trade at 1,600, because that is basically where we are right now. We're expecting the price to go to 27, 28, $3,000. And if that happens, your $3,000 sell trade is not going to be $3,000 anymore. It's going to be $5,000. That's why I've said you are hedged. I understand that, but you still have to then close out your buys and your sells equally to reduce those that hedge. So you're in exactly the same position. You're only going to be making 10% profit per month. How you handle it, it's up to you. I'm just giving you the math to show you what the difference is between if you closed it out now and you close it out later.
No, it's interesting. That's why I'm asking.
Okay.
But I was wondering about that 2,200 fair value gap.
So that we may never get there. We may never get back to that value. Maybe something happens by that time. Maybe Kamala comes into power and there's zero faith in her, and the price of gold spikes to $3,500. Maybe she decides to go nuclear. The price goes to $5,000. Maybe Trump comes in and he's also like Khatful, and he goes to war with Russia. China gets involved. North Korea gets involved. World War III starts. Then we're definitely going to $30,000 an ounce. So we can't say. I'll just try and minimize this. So there's 2,200, 2,300. There isn't one at 2,200. Mute yourself, please. So there's one over here, 2376. There isn't one at that level that you're saying. What
FPS
level?
had a fair value gap on the monthly at 2.2.
Okay. A monthly. Let me go back to my other 8036. Okay, there it is. Okay, there it is over there. 2287. 2205. It's $600 away. That's 600 pips. There has to be a proper war for that to happen. I don't see any indicators that can point in the direction of a $2,200 gold price. Like, they're insolvent.
I agree with you. I'm just asking.
Okay, so this is why I've closed out. This is why I closed out my trades rather. Well, I didn't. I mean, I got caught in a. The EA did it for me, which I'm very happy about. And Warren also closed out his trades. A couple of you guys have closed out your trades, and it's been the best decision they've ever made. Not telling you what to do, just giving you. You've read the comments, obviously. I just don't think that the price is going to go back to 2,200 with the way that it's looking in America and globally. I think the consensus is worldwide. I think if you listen to all the gurus out there, whether it's Gareth Soloway or whoever, Kathy Wood, Kiyosaki, any of them, I think they're all saying it's cataclysmic. Anyway, have you guys got anything else to add? Any other questions, or can we call it a night? All right, guys, I hope that you enjoyed this evening. If you did, please leave your comments on the EA Strategies group. That would be great. And, or rather on the testimonials group, EA Testimonials group, so that other people can check what you thought about it. It's the only way I can improve. It's the only way, again, I can improve our content. If you feel that it needs improvement or where we can fix our presentation so that you can have a better understanding, please post it so that we can consider it and be better presenters for you. Thanks, everybody. Take care. We'll see you soon.